Good morning, everyone. This is Charalambos Pissouros, senior analyst at IronFX, bringing you the morning comment for the 1st of March. The dollar surges after a salvo of FOMC and Trump remarks. Overnight, the US dollar outperformed most of its major counterparts following a barrage of hawkish remarks from FOMC officials, as well as comments on infrastructure spending by President Trump before Congress. The dollar rally was triggered by New York Fed President Dudley, who indicated that the case for a rate hike has become a lot more compelling, while the chorus of optimistic FOMC comments continued with St. Louis Fed President Bullard and San Francisco Fed President Williams, both of which indicated that a near-term rate hike is a considerable possibility. While investors were still digesting these remarks, President Trump stepped up to the rostrum to deliver his first address to Congress. Although the president did not offer much detail on tax reform, he did provide some specifics on infrastructure spending. He said that he will ask Congress to approve $1 trillion worth of investment in infrastructure. These comments added extra fuel to the dollar rally, ignited by Fed policymakers. Dollar-yen surged after it hit support near the key obstacle zone of 111.60, and subsequently it crashed three resistance, now turned into support barriers in a row. Currently, the rate looks to be headed towards the 113.80 resistance line, where a decisive break is possible to open the way for the crossroad of the 114.40 zone and the downside resistance line taken from the peak of the 19th of January. Nevertheless, although the pair may continue trading north for a while, we maintain the view that the short-term path remains sideways. The rate has been oscillating between 111.60 and 115.50 since the 11th of January. As for our view with regards to the next rate increase, we stick to our guns that June is a much more likely candidate than March. In order for us to reevaluate this view, we would need three things to happen in the next days. January's core PCE price index to accelerate today, Fed Chair Yellen to echo similar remarks with Dudley in her speech on Friday, and February's average weekly earnings due out next week to accelerate notably. As for today, the highlight will be the Bank of Canada rate decision, and the forecast is for the bank to remain on hold. Following a neutral statement at the latest meeting, Governor Pissouros was quick to backpedal on that stance in the press conference following the decision. He said that another rate cut remains on the table should downside risks materialize. Since that meeting, economic data and developments have been encouraging on balance. As such, we share the view that the bank is likely to remain sidelined, and we expect the tone of the statement to remain neutral, something that could prove positive for the Canadian dollar. However, there is the possibility for another warning about the strength of the loonie, considering that the currency has traded sideways against most of its major peers since the last gathering. Such a warning could offset some of the potential positive reaction in the currency. Dollar cut jumped overnight following Fed officials and Trump's remarks, and is currently headed towards the 133.40 zone. We believe that the pair is possible to continue trading higher in the days to come, but a relatively optimistic statement from the Bank of Canada today could be the catalyst for a corrective setback. A dip back below 133 is possible to confirm the case for such a retreat, and perhaps aim for the 132.20 support zone, marked by the peaks of the 7th and 22nd of February. As for the rest of today's highlights, during the European day we get the final manufacturing PMIs for February from several European nations and the Eurozone as a whole. From Germany we also get the preliminary CPI print for February. The forecast is for the rate to have risen above 2%, which could raise speculation that Eurozone's overall CPI, due to be released tomorrow, may follow suit and thereby support the euro. From the UK, we get the manufacturing PMI for February. Expectations are for the index to have ticked down, but to have remained elevated well above the 50 mark, separating expansion from contraction. From the US, we get a plethora of economic data. Let's kick off with personal income and spending data for January. the forecast is for income to have risen at the same pace as previously, while spending is expected to have slowed. We also get the ISM manufacturing PMI for February, and expectations are for the index to have held steady. Finally, we get the core PCE price index for January, though no forecast is available. Given that this is the Fed's favorite inflation measure and that this rate has been range-bound since February 2016, we expect it to attract a lot of attention as investors try to gauge the timing of the next rate hike. A potential increase in this rate could amplify further market expectations with regards to a March hike. We have only one speaker scheduled for today, Dallas Fed President Robert Kaplan. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.